Whoa, what are we back from?
We're back from Orlando.
Oh!
We are very tired and sleepy.
We did not go to Disney World, though.
Not get to go to Disney World, but
it's actually kind of disappointing.
Talking apartments is just as fun as Disney World to me. So spent the whole weekend networking and hanging out with some of our friends.
Yeah, MFM Con was a success. We had close to 300 people out there, a lot of networking, a lot of just building new relationships, kind of, I think, brushing off some cobwebs on some old ones too, right? It's amazing. Some people we hadn't seen in a couple years, thanks COVID. But got back at about 1 o'clock last night and was back in the office this morning.
Yeah, so we had a blast. So for those of you
that
attended, thanks for coming out there.
Thank you.
Could have been as awesome without you guys, but we made it back. And of course, what are we doing?
Money Mondays.
Regardless, come rain, snow, sleet, hail, or
There's been a couple pauses to this show,
out.
but we do try to do it as much as we consistently can, right? So we do it every Monday. What time?
3:30 Central.
Ish. Oh, you didn't think that I was going to forget that, right?
Nope.
But what are we talking about today, man?
We are talking about red flags and multifamily real estate offerings. So for those that don't know, an offering is what a sponsor introduces and presents to people, right? And just kind of talking about some things to look for, right? As an investor, what should you look for, right? Good, bad, and ugly. And,
we have gone through the same presentation on a couple presentations lately, right?
Absolutely.
So I think this is important for not only, I think, passive investors to understand this first and foremost, but really to make sure if you're offering a deal that you're not tripping any red flags either. So from an operator standpoint, I think you need to understand this stuff too. So we're going to get right into it. We've got property-specific warning signs, and then we've got kind of business plan / returns warning signs, right? Two different concepts. So property-specific, sub-market specific, really, is a decreasing population, right? I mean, we kind of throw some markets under the bus, right? But, people are moving out of Michigan and Detroit and some of these other markets. And so at the end of the day, where are they moving to? They're moving down south to the Sun Belt, right? So when you've got a decreasing population, that can put further strain on you being able to push rents, right? Because you're going to have less renters that are going to want your property, right? So you have to look at that type of stuff. Low absorption rates, right? That typically means that there's demand for rental products and they get absorbed into the market more quickly, right? When something is in lease up for 24 months and they're having to give half a year free rent just to get somebody in the door, that means that there's less demand for rentals in that area, right? So that's important to understand. Decreasing rental growth, right? I mean, when rents are going down, and if they're going down right now, then you got big problems because across the board we're seeing some really strong lease trade outs.
So as an investor, right, you want to invest in places that make it easy for you, right? It's not that there's a right or wrong, right? But by investing in a market that's growing, right, it makes it more likely, or maybe less likely, that you're going to get bogged down with problems and not be able to perform.
That's true.
Right, and so this is where people make money in every market, right? Good, bad, and ugly. Whether you're investing in whatever the towns, Odessa, Midland and Odessa and West Texas, which is just 90% tied to oil, or you're investing in the heart of Silicon Valley, right? Heart of New York. People make money. There's not a right or wrong. But these are things that we look at it as just simplifying things, right? I like to, Ben likes to ride his bike with training wheels, right? Because it's easier for him versus having
I don't know how to ride a bike, man. Come on. It's only been 35 years, but I have taken the training wheels off. But you're right. Right, consistency is, and it makes things a lot easier, right? Because what we do is inherently complicated as it is, right? There's a high barrier of entry. We're talking about this in MFM Con, right? That is why it's a lucrative business to be in. We solve big problems, folks. And so, anything that you can do to simplify your life along the way, you should go ahead and do. And so buying a property into, a high growth market or something that's got a little bit of wind in its sails is also a great thing, right? But, all right, comps, not near the subject property, right? I think that some people, there's two arguments to this, right? That if you're one of the only places in a market where there's some other jobs that, right, you're the only place that they could potentially live. But I think when we're looking at it from a red flag standpoint, right, that could also be seen as there's just not a lot of new development that had been happening in that area because there's just not a whole lot of growth in that area too, right? But I'd also say that some people that are offering deals out in the market, right, are going to pick comps that are 5, 10, 20 miles away just to justify the rent growth that they're trying to pitch to their investors. And so you need to understand that too. Do the rent comps make sense, right? You know, the other thing that we've seen, which is kind of a little sneaky, but people do it, right? You've got a 1975 property that you're trying to pitch to your investors, but you're using comps that are from the 1990s. Right? It's not an apples to apples comparison, folks, right? There's totally different product set. Maybe those units have washer and dryers in them. Maybe they have a resort style pool and all these crazy amenities because it's an A-class deal versus your 70s product that might not have any of those things. That's the reason why there's a difference in rents. So understanding that at the property level and, you know, as people are pitching you deals, that's important as a passive investor, right?
Absolutely.
We got a pro tip here. Oh my gosh. In underwriting, it's critical to analyze the neighborhood and the submarket.
Yeah, so there's a lot of tools out there, right? City data is a big one. Understand the area you're in. And again, it's not about good, bad, and right or wrong. It's just about some, you know, if I'm charging a rent that doesn't make sense for that demographic, probably going to be hard to hit those rents, right? And so really, you know, again, as a passive investor, because I think really this whole conversation is geared more towards passive investors. As a passive investor, you're looking for things that are going to increase the likelihood of success on the investment, right? And then you're looking for things that are red flags that are like, wait, you know, I definitely got to keep an eye here, right? You know, like if that guy really feels creepy, like that's a red flag, but he might not be creepy to be okay, right? So it's just the example I thought of. But, you know, you're looking for those kinds of things, both on the deal and the investment opportunity, as well as the other side of things, right? Which is more about the company agreement, the partnership, and all those pieces, right?
Yep, absolutely. So I mean, property specific, and we'll kind of get into that here, maybe even on the next slide, right? But there's ultimately neighborhood level data that you need to understand, you know, crime scores in the area, school districts, right? And we'll probably get into some of that, but those are other things that as a passive investor, you can go look up online. Now, the data might be a little stale. You might have to pay for, I guess, more real-time data, but at the end of the day, you need to understand that, right? And maybe one of your criteria, we always talk about on the show here, the box, right, that you want to invest in. Maybe, you know, you want to only be in top 5 school districts in any one state that you're investing in, right? Okay, well, that's really limit your box, but you can quickly look that up and find out if you are in a top 5 one, right? So, switching gears here, we're talking now business plan / return wording sides, right? I'd say the biggest thing, and I don't even know if you, maybe you could or couldn't do this. Sometimes it's a little vague, it's a little bit hard to determine, right? But you really need to understand how the splits work, right?
Yes.
And I think
understand the structure, people, not just what you're told, but what the paperwork says.
Yes, it could. That's a great point because it could be 2 totally different things,
and
right?
Sometimes the operator doesn't even really understand what the paperwork says, which is
it's an even bigger problem.
We've seen that.
That's a big problem, right? So you need to understand how the splits work, right? A dollar goes in, right? How does all of that dollar get spread out amongst the GP and the LPs and their hurdles, and what does that ultimately all look like? And some of that's, you know, should be disclosed. Actually, any legit SEC attorney would put that into the PPM. But let's be honest, not everybody reads this stuff, but you should, right? So don't just take what's in the deck and say, oh, that must be it, right? Read the PPM. That is the overarching document of this whole entire thing, right? So it doesn't matter if this guy or girl gave you, you know, this is what it looks like and this is what the splits are. The PPM might say something different, right? So understanding that's important. I'd say also not understanding the fee structure, right? Some people straight up just don't even tell you any of the fees that they're taking, which is a bad thing in itself, but then just kind of understanding what those are and what are they based off of, right? And I'll give you guys an example, right? You're looking at an acquisition fee. Some people take an acquisition fee off the purchase price, which is what we do, right? Like a broker, right? Or some people might take an acquisition fee off of something else, right? Call it the equity that's raised. Or it could be off of something else too, right? Ultimately, you need to understand what is the actual percentage, first and foremost, of the fee that these people are taking, and what is that based off of, right? And I'll give you another one. Off of asset management fees, some people will take that off of a different number. We take it off the total income that the property makes on a monthly basis, right? And then we apply whatever the fee is. In most cases, it's 1.5 to 2. And so people need to understand what those fees are and how they're calculated, because that's going to affect returns. Now, one thing that we do every time that we're presenting a deal, all returns are presented net of any fees, right? Not everybody does that. In fact, we've seen plenty of investor decks where it's a gross number. And guess what? They look a lot different than a net number, right? And so sometimes people are wondering, how are these guys getting a 20% IRR? Most of the time it's because it's a gross number. So you need to understand that, making sure, hey, are these net to me, or is this just a project level return? Because there is a difference. I'd say this without saying, but we can never guarantee anything. No returns are ever guaranteed. Past performance is not indicative of future performance. And anybody that's out there telling you they can guarantee you something is doing something illegal, right? So you need to understand that. That should be a huge warning sign. No set aside reserves. Right, I think we've learned that, over the years, right? To have reserves and making sure that they're sitting there in case something happens. COVID, right? Slowdowns, no rent growth, people aren't paying rent.
Deals this day, a lot more cash, right?
Absolutely.
Sorry, and as an investor, understand what risk adjusted is.
Yeah, you need to understand that, right? But having those reserves, right? Some people come in very little capitalization on their deals. And then the first sign of trouble, they might hit you up for a cash call, right? So you need to understand that too. And what is the cash call situation look like, right? Is it mandatory? You need to read that within your company agreement and your PPM, right? Or is it voluntary? If it's voluntary and you say, hey, I can't do it, maybe times are a little bit slow, don't really feel comfortable throwing good money after bad, whatever it might be, you're probably going to get diluted. So you need to understand that too, and how does that all kind of work from a return standpoint? Another one that we have down here, right? Unrealistic and aggressive revenue growth. Natural revenue growth is typically anywhere from, I'd say we have 2 to 3 in the slide. I've seen nowadays you're probably 2 to 5, at least for the next 12 to 18 months, just because of where rents were for so long. They're now kind of popping. It's like a rubber band effect. But if you start seeing 10% across the board for the next 7 years, that's how that person is trying to position the deal. That's aggressive. And that's not indicative of where the market has ever been and will ever be. So you need to have that, and that's a red flag too, right, as a business plan. And I think the one thing that really kind of drives a lot of these, is it a good deal or is it a bad one, is your exit cap, right? The reversion cap, whatever you want to call it, the cap rate at the sale of the property when you go to sell, right? What is it going to be? And ultimately, beyond maybe the next 12 months, 18 months, 24 months, right, tops, it's really just a crystal ball type situation. Mm-hmm. So, but you really want to have something that's higher, right? So if I'm buying it at a 4.5 cap, right, we're going to underwrite it to a 5.5 cap exit, right? And really the rule of thumb, because people always ask me this, it's anywhere from 10 to 20 basis points per year that you hold the deal. Is typically the rule of thumb. Now, what we've seen the last 5 years is that actually cap rates have gone the other way. So it's really propped up a lot of deals and made things a lot more profitable. Now, we're not going to say that that's going to continue to happen, but something to be aware of, right? And so when you see somebody that's buying a 4 cap deal and they're going to sell it at a 3 cap, doesn't mean that it's a bad deal, but maybe something to look at. It could be a red sign or a red flag, excuse me. Boom, man, I got through that pretty quick.
I know.
All right. We got any questions?
Let's see, so if you have comments, questions, thoughts, ideas, you want to say hi, you want to make fun of Ben's hair,
or lack thereof,
feel free to go ahead and leave a comment, and I'll go ahead and read it live. We did get a few questions, so.
All right.
One of them, Lauren says, as a rule of thumb, the radius should be 1 mile to 3 mile radius. With standard, the appraisers
Is she asking or is she telling?
This is telling. But
yeah, I think I would.
1 to 3 miles is a good radius, right?
I would say that.
Depending on where you are too, right? If you're in some downtown areas, like let's say you're in the middle of Manhattan, Yep. 3 miles is very, very far. You are in a very, very different submarket.
And it's extremely dense market too, right? So you might have
Houston, 3 miles, not as big of a change. So,
yeah.
But 1 to 3 is a good.
And typically, what we're seeing on the vintage side, right? 5 to 10 years within the same vintage is typically what we do as well, right? And you don't want to have a 50-unit complex and your comp is a 350-unit complex. They're just different. They're different animals. So I agree with that.
So let's keep going. So,
all right.
Are replacement reserves replenished below the line or included as an expense?
Replacement reserves are below the line.
Yeah. Well, no. Replacement reserves are above the line. Capital reserves are below the line.
Yes,
right?
That's confusing.
Yeah. So I'm trying to understand what you mean by replenish, though.
All right. So I think at the end of the day, right, your replacement reserves, you're right. right? It's just like
Yeah,
it's like
part
any, let's take
placed
it's a
in-
tax.
part placed in AC. That is a replacement reserve.
I'm not even talking about that. I'm talking about it's a tax, insurance, and replacement reserve escrow, right? Then you combine that with your note. That is your total mortgage payment every month, right? And so typically, now we've seen it both ways. I've seen people do replacement reserves below the line, and I've seen people put replacement reserves above the line. Typically, ours, when we underwrite it, are above the line,
on
right?
the expense side.
On the expense side, right? Now, ultimately, it should be offset because it's a
really,
wash.
And it's really, and I guess
It's a wash.
Whenever we underwrite it above the line, right? But a real financial should have it below the line, right? Because we're also saying, hey, we know we're going to have some because our expense whenever we're underwriting, really we're trying to look at net true cash flow. That's why we put it above the line. But in financials, it actually really goes below the line. So.
This is a 3:30 p.m.-ish show, man. We're getting way in the weeds here, all right? Yeah. So, no, I get it.
Let's keep going. So, Shane says, do you see a red flag in PMs requiring a capital transaction fee upon a sell in their agreement? No. I mean, ultimately, I'm going to say this. Property management is very, very hard. They need to make money. As a owner, as an operator, like, if you're not going to use a really good management company because they want to get paid something on the exit, that's short.
So was that question, or was that from an operator standpoint?
Nothing it says. Do you see a red flag in a property manager requiring?
Oh,
right. And so you can always terminate them if they're doing bad, right? 30-day out. But I mean, if a management company, every time we've sold a deal, we've always given.
But that's a retention bonus, right? You know, so I'd say it's maybe a little bit different than.
And the management companies have gotten a bonus too. And so ultimately, if a management company does a very good job, right, they're probably worth their weight in gold. And for half of a point, you know, and it depends. I guess we're talking about half a point of the sale price or half.
I don't. To be honest with you, I don't think that's ever been baked in any of agreement that we've had. But we definitely have had retention bonuses, which sometimes does go to corporate as well. But that's in the grand scheme of things. I don't think I've on the 7 or 8 exits that we've had. I don't think we've ever paid more than maybe 30 to 50 grand tops. So it's a rounding error in a lot of these transactions. And it keeps people motivated and keeps them on task, right? Because at the end of the day, they don't know if they're going to have a job when the dang thing sells, right? So that's why it's called a retention bonus. You're trying to keep people there on property and doing the right things, right? But good question. I think it's in the eye of the beholder, right? Would be my answer to that. So, we have any other questions?
Keep going. If you have any comments, questions, thoughts, please leave them. Otherwise, we keep going. So going twice. All right, let's keep going.
All right, we're going. All right, so the toolkit. We haven't talked about toolkit in a few weeks, but this is where all of our checklists, all the webinar replays are, all of our podcasts. Shanna does a great job curating this content. There's a lot of great value in what we've put out there, right? And all of it's for free, right? So check it out. www.disruptequity.com/toolkit. It's all there in one spot. So check that out.
And let's see. So we did get another comment. One of my favorite comments. Michael Del Pier says, "What hair?" He does have a few hair follicles up there. So
Michael, buddy, I haven't seen you in a while, man. You have the same haircut that I do.
And
so
Michael says, "Any red flags on lending?" There's a lot of red flags. Lending is tough. But I guess
I mean,
a passive investor, red flags on lending.
Over leveraged, right?
Make sure it's a 3-1-1 if they're doing a bridge.
Yeah, that's important.
Understand what interest rate cap they're doing. We've bought down all of our interest rate caps on every deal. We paid extra to get a lower interest rate cap, so it's less risky, but it costs more money, right?
I'd say that's probably it, and just understanding, the servicing side too, right? You don't need to get too far in the weeds as a passive investor, right? But some of the challenges that we've had in the past with lenders has been on the servicing side, right? Where they've really jammed and mucked up the whole process. So how much stuff is escrowed? How many lender required repairs are there, right? Because that's all going to jam up the works. So, but yeah, I would say really interest rate, term, and leverage are the 3 most important things that as a passive investor you need to understand at least, and that should be part of the deck. If it's not part of the deck, then I don't know what the heck they're doing. But, so it's not necessarily a technicality. It's typically something that's part of the business plan. And so they should disclose it, right? But we need to see you out at one of our events, man. It's been a while. All right. We're going to keep going or what?
Let's keep going then.
All right. We're talking MF Investor Network.
Oh, sorry, prepayment. He said prepayment penalty. Yep, that is a.
That's huge, right? We know that has cost us some money too, right, on the exit. but the returns were still there. So at the end of the day, it worked out. But is that baked into their analysis, right? And sometimes it's not, right? Because prepayment penalties, especially the first 2 to 3 years, can be extremely onerous. So you need to understand what that is. Is it yield maintenance? Is it defeasance? Or is it just a straight 1%, right? We've got a Freddie Mac deal that we love because it's 1 year lockout and then it's just 1% of the loan amount, right? It's very easy to calculate. It's very easy to underwrite to, and ultimately it's clean, right? Whereas you have yield maintenance and everybody can look all this stuff up. It's, I don't know, they spit something into a supercomputer and it spits out a number of how much you owe. But at the end of the day, it's substantial in some cases. Think more like 10 to 20% prepayment penalties. So, boom, we got through it. Talking the conference, Multifamily Investor Network Conference. Our next one, we're really, really excited about this one. 500 people? I don't know.
400 or 500 people.
It's going to get crazy.
We're looking forward to it. So.
February 12th, 2022, right here in Houston, Texas. Same venue that we've had our last few ones at, that have been here in Houston. People love it. We always get a bunch of great feedback. We'll have some great speakers, maybe do some panels.
So if you attended the one this past weekend in Orlando, this is going to be just as much fun. So.
Yep, and probably even a little bit bigger, right?
Yeah. Oh, definitely will be bigger.
So let's talk about the coupon code. So if we could go back real quick. So disrupt at checkout, get $100 off that executive ticket. But once again, mfinvestornetwork.com, February 12th, 2022. Right here in Houston, Texas. So what are we talking about next week, man?
Talking about building your brand and real estate business. We did this panel at the conference this weekend, had a ton of interest, and we decided, hey, probably be something people want to hear more and talk more about. So we'll talk about that. We'll give you a couple of tips, tricks, and secrets. With that said, let's see any more comments. Chris Collins says, you guys are beasts. Definitely try.
Don't worry, man. I'm tired. That's why I got
it. Wicked conference back to Houston, straight to live Mondays. Yep, that's what we do, Chris.
It's all about being consistent, man. We gotta, we couldn't use that as an excuse not to come on and try to add some value to people.
So with that said, thank you all very much.